This question will walk through the calculation of basic earnings per share. On January 1st, 2020, Saved by the Bell Limited had 580,000 common shares outstanding. During 2020, it had the following transactions that affected the common share account. On February 1st, we issued 180,000 shares. March 1st, issued a 10% stock dividend. May 1st, acquired 200,000 common shares and retired them. June 1st, issued a 3-for-1 stock split. October 1st, issued 60,000 shares. The company's year end is December 31st. The first thing that we're asked to do is determine the weighted average number of shares outstanding as at December 31st, 2020. Okay, so let's work on that first of all. So let's set up our table. So I find it helpful to set up this table and have consistent headings every time I'm calculating the weighted average number of shares. So the headings that we're going to include are as follows. So we're going to have event, then we're going to have dates, we're going to have shares outstanding, and this is cumulative shares outstanding. We're going to have restatement. In case there's stock splits, are the things that we need to take into account. We're going to have the fraction of the year. And then we're going to have our weighted average column where we're going to have our totals. So these are our headings here. So the first thing that we normally have as our first event is going to be the beginning balance. So let's take a look back up at the question and see what our beginning balance was. So we can see that Saved by the Bell had 580,000 common shares outstanding on January 1st, 2020. So we know that's January 1st as the date. And when does that change? So January 1st, and the next change is going to happen on February 1st. So what I'm going to do is I'm going to take down here and I'm going to say my dates are going to be January 1st to February 1st. And that's because on February 1st, there's a change in the number of shares. So whatever I have on January 1st is going to be constant for the month of January. And that's going to be that we're going to have 580,000 shares outstanding. Looks like a weird 8. And that's going to be for 1 month out of 12 months in the year, because it's only going to be consistent for the month of January. And then February 1st, we've got something else that's going to happen. So February 1st, we're going to issue 180,000 shares. So our event is going to be issue. And this is going to be February 1st. And I forgot to check when our next transaction is. So the next transaction is March 1st. So this is going to be consistent only for the month of February. And we're going to issue 180,000 shares. It's really important to realize that this is a cumulative number of shares. So we can't just write 180,000 there. That would be a huge decrease from the 580,000 that we had in January. So we're going to take 580, we're going to add 180,000. So our cumulative total is going to be 760,000 shares. And this again is going to be for one of 12 months because it's only for the month of February, and then something else is going to happen. So we got that one. Now May 1st is our next transaction. Oh, sorry, March 1st issued a 10% stock dividend, and that's going to go until May. So we're going to have 10% stock dividend. And this is going to be from March 1st to May 1st, because that's the next transaction happens in May. And how do we recognize a 10% stock dividend? We're not given any numbers. Like here we're given 180,000, here we're given 580, and all we're told here is that it's a 10% stock dividend. Well, what we need to do, it means they're going to get an additional 10% of shares. So we're going to take 760,000 and we're going to multiply it by 1.1. And that is going to give us 836,000. So that's 10% more shares than we had existing in the prior portion of the year, the 760,000. Now, let's first write down our fraction of the year. So March 1st to May 1st is 2 months out of 12 months. And now, is that it? Can we stop there? No, we cannot, because stock dividends have to be restated for the whole year. So even though January, the month of January and the month of February did not have a stock dividend, the stock dividend happened on March 1st. It's going to make the number of shares incomparable for the rest of the year. It's not really going to make sense because all of a sudden we just arbitrarily increase the number of shares by 10%. So we're going to need to do that for the previous portions of the same year, just so that we're working with the same numbers. It's really a consistency issue. So we're going to have this is going to be times 1.1 just for those two prior periods. And we don't put the 1.1 for March 1st because we already did that math. Remember when we took the 760,000, we multiplied it by the 1.1 to get the 836. So we're going to leave that one alone. And everything afterwards in our periods of the year will already be restated for the stock dividend. So we really only need to worry about what happened before. Okay, so now we got that one. Now, May 1st, we're going to acquire 200,000 common shares and retire them. So we're actually going to decrease our common shares. And this is going to be May 1st. Now, what was our next transaction date after May? June 1st. So it's only 1 month again. And this is going to be a negative 200,000 because we're retiring these shares. So again, because this column is cumulative, we're going to take 836. We're going to subtract 200,000. So that's going to give us 636,000. And again, this is 1 over 12. Okay, so we got that one. Then we've got June 1st issued a 3-for-1 stock split. And that goes until October 1st. So we're going to have 3-for-1 stock split. It's going to be June 1st to October 1st. And now what do we do? Same thing as the previous stock dividend. We're not given any numbers. We're just told it's a 3-for-1 stock split. Well, what that means is that if you're holding 1 share prior to the stock split, you're going to hold 3 shares afterwards. So they're basically dividing all the shares into 3. So meaning that you end up with that many more shares. So what we're actually going to do is we're going to take the 636,000 and we're going to multiply it by 3, because if you're holding 1 share on May 1st, they're going to take that share and give you 2 more. So you're going to hold 3 shares. So now the number of shares, so 636,000 times 3 is going to give us 1,908,000 shares. And June 1st to October 1st, which is a longer period. Now this is the longest period we've seen. We're going to have 4 over 12. Is that it? Well, remember what we said here, that we had to restate the periods prior to the stock dividend. This is the exact same thing. We have to restate the transactions in the year that are prior to the 3-for-1 stock split. So what that means is that everything before June 1st, we have to multiply by 3. So we're going to have multiply by 3, multiply by 3. And here we already are multiplying this by 1.1 for the prior stock dividend. Now we have to multiply it by 3 as well. So now we've got a stock dividend and a stock split. Okay, does that make sense? And we're not doing anything on June 1st because we already did the math there. Remember how we took the 636 and we multiplied it by 3 to get the 1.908 million. So we don't change that. And everything afterward will already be restated for the stock split and the stock dividend. So we leave that alone. We're only looking backwards and making sure that everything prior was consistent. It's fair enough to say that the stock split didn't exist in January and the stock dividend and the stock split didn't exist in May and prior. But the reason we're doing it is for consistency. So the number of shares makes sense when we're looking at it. Otherwise, when we do the weighted average number of shares, we'd have way too little shares. So if the shareholders had 1 share and then they're going to end up with 3 shares later, we need to think about that as if that happened for the whole year so that we get a number that makes sense at the end of the year. Okay, so we got that. And I think there's one more transaction, is there? Yeah, October 1st, we're going to issue 60,000 shares. So issue, this is going to be October 1st to December 31st. And we're going to add 60,000. Remember, this is cumulative, super important. If you had numbers in here that are moving around, that are not increasing, and it's not because of a retirement of stock, then you probably have made a mistake where you haven't included a cumulative number. So it's something to watch for. So 1,968,000. And that's because we took the 1,908,000, we added 60,000 shares. And October 1st to December 31st is going to be 3/12. So the next thing that we need to do is simply run the math through for these columns so that we can run the math through this way. So we want to run the math through horizontally so that we can fill in these columns. We need the numbers here so that we can add up. This is the number that we're looking for. So if we take 580,000, we multiply it by 1.1, we multiply it by 3, and then we multiply it by 1/12. We're going to end up with weighted average shares for the month of January of 159,500. February, 760,000 times 1.1 times 3 times 1/12. We're going to end up with weighted average of 209,000. March, 836 just times 3 times 2/12 is going to give us 418,000. Okay, and May 1st to June 1st, 636 times 3 times 1/12 is going to give us 159,000. And 1.9 million times 4/12 is going to give us 636,000. And 1.968 million times 3/12 is going to give us 492,000. So if we sum up all these numbers in this column, our cumulative total is going to be 2,073,500. And that is our weighted average number of shares outstanding. So we had an average of 2,073,500 shares outstanding for the year of 2020. This is 2020, right? Yes, 2020. Okay, so we've completed part A of this question. So part B states, assume that Saved by the Bell earned net income of 2.5 million during 2020. In addition, it had 100,000 of 8%, $100 par, non-convertible, non-cumulative preferred shares outstanding for the entire year. Because of liquidity limitations, however, the company did not declare and pay a preferred dividend in 2020. Calculate earnings per share for 2020 using the weighted average number of shares determined in Part A. Okay, so it's a convertible instrument, non-convertible, non-cumulative. So look at this. This word is really important, non-cumulative, and the company did not declare. So as we talked about in the lecture, for preferred shares, we always take off the dividend if they're cumulative or if it was declared. But if they're not cumulative and it wasn't declared, then the preferred shareholders actually don't have a right to collect the dividend from 2020. Not all preferred shareholders require a dividend. It has to be cumulative or declared. Not cumulative means that they're not entitled to it if it's not declared. So we don't actually have a dividend on preferred shares in this instance based on this information. So let's calculate our earnings per share. So let's find our net income actually up here. So we're told that they had net income of 2.5 million. So let's write out our formula. Earnings per share equals net income minus preferred dividends divided by the weighted average common shares outstanding. So in this situation, we know that this net income was 2.5 million. And the preferred share dividends are 0 because they're non-cumulative and they were not declared. So those shareholders are not entitled to a dividend. If it was cumulative, it would be a different story because we would have to pay it. Even though it wasn't declared, it would still be owed to them. So we would deduct it. But because it's not cumulative, we won't. And we're just going to take our weighted average number of share number from up above, 2,073,500. And this is going to give us $1.21 per share. So for 2020, common shares earned $1.21 per share. And that's the answer to B. So let's take a look at C. Assume the same facts as part B, except that the preferred shares were cumulative. Okay, so if they're cumulative, it means that even though they weren't declared, the company still owes them. They need to catch up on that dividend before they can issue any sort of distribution to the common shareholders. So even though it wasn't declared, we still take it off in our calculation of earnings per share because it's cumulative. If it's declared or cumulative, we'll take it off. So in this situation, we're going to have the same numbers, the 2.5 million net income. But now we're going to deduct. Now, what is the preferred share dividend? It says it's 100,000, 8% dividend. Net income in at 100,000, 8%, $100 par. So we're going to take 100,000 times 8% times 100. So we're going to take 100,000 of these bonds, or 100,000 8% preferred shares. So they're 100,000 and they're each worth $100 and they pay a dividend at 8%. So we're going to multiply 100,000 times $100 with the par value times 8%, which is going to give us a dividend of 800,000. We're going to multiply this by the exact same weighted average share number. And this is going to give us earnings per share of 82 cents. So you can see that the impact of this cumulative preferred share dividend that we have to pay, the company has to pay out before they can distribute the dividend to the common shareholders, significantly decreases the earnings per common share from the situation where we didn't have a cumulative preferred share dividend. Okay, so now we've got C. So D, assume the same facts as in part B, except that net income included a loss from discontinued operations of 200,000 net of applicable income tax. Okay. So net of applicable income tax. So we know we've got net income of 2.5 million. And now we're told that we had a loss from discontinued operations of 200,000. So remember, a loss is always going to be negative. So what would our income from continuing operations be then? And this is important terminology. This is the terminology that will be used in the financials. Of course, I'm abbreviating it here, but it's called income from continuing operations, loss from discontinued operations, and then net income. Well, we must have had to make more than 2.5 million if we can subtract 200,000 from it. So we would have had to make 2.7 million. Because 2.7 million minus 200,000 is 2.5 million. So we're just solving for the unknown there. So now we need to figure out what our earnings are. We need to use our earnings per share numbers here. So we're simply going to take this number, divide it by our weighted average shares outstanding. Which is 2,073,500. This is going to give us earnings from continuing operations of $1.30. we're going to take the discontinued operations, divide this by 20, the same number. Of course, our weighted average shares don't change. There haven't been any more shares issued. We're simply dividing it through. So this is 0.099 cents, but don't forget, we need to make sure we're showing that as a loss per share. This is a loss. So of course, dividing it by here, we need to make sure we're showing a loss per share. We didn't earn anything on the common shares. We actually lost money on discontinued operations. So we have to lose money per share. And then net income is simply the same number that we did above, but let's just do it here for illustration. So then we end up with our 121, same as above. And that's what that would look like. Of course, this math wouldn't be shown, but the numbers there are exactly what would look like in the financial statements. Okay, so now we've got D, and E says, what is the reasoning behind using a weighted average calculation for the number of shares in the earnings per share ratio? Well, the rationale for that is that the earnings process, or the process of earning net income, occurs continuously throughout the year. And net income is, of course, our numerator in the calculation of earnings per share. We must recognize that the income for the year was generated from capital available throughout the year, because the share capital is what's giving us the cash to generate the net income. So we can't look at the amount of capital at a point in time. We need to make sure that we're considering the fact that the capital is a moving number over the year. So we need to make sure that we're taking into account an average number for the weighted average number of shares, because you could have 0 shares outstanding at the end of the year and a huge amount issued in December. It wouldn't be fair to use that as your denominator, because those shares have only been outstanding. You've only had the benefit of that capital for a very short period of time. So because the shares numbers fluctuate, we need to take into account the fact that that capital was available over the year. So that's E. And that concludes this question.